Are you looking for some fabulous long-term dividend growth stocks paying a dividend and growing it, and these are safe stocks? These are the darlings of the hedge fund industry. So stay tuned. 5 picks, short period of time. Let's get into it and wait till the end to hear some really important points about the valuation on these stocks before you think about investing. Let's have a look now. Okay. Now, we're going to look at the 10 best blue chip stocks here to buy according to hedge funds. So this is a Yahoo Finance article. They talk about the Silicon Valley Bank going under, and scrolling down, we can see that they've really tried to look at some of the most highly or widely held stocks by elite funds in the database at the end of Q4, and they've generated a little list of the 10 best blue chip stocks. Now what I've done is I've switched over to fast graphs. I have listed the top 10 stocks that they've picked here. So these are blue chip stocks widely held by hedge funds, which are often considered to be fairly sophisticated investors. Now as we look through, we can see not all of these stocks are going to be paying a dividend, and so what I've done is I've just created another view here on fast graphs in the portfolio, and I can sort by dividend yield. Now there's a couple of points I want to make here. We've got the Bank of America, JP Morgan, so we've got two banks. We've got S&P Global, which is in the finance industry. Then we've got Apple and Microsoft. So we've got very little diversity here in terms of the companies paying a dividend on this list, but it ranges from about 0.9 through to about 4% dividend yield here. Now the EPS yield is relatively low for some of these, but seems to be quite high for Bank of America and JP Morgan, which is probably not surprising at the moment given the turmoil in the banking sector. So what I've done out of these top 10 stocks, I've taken the dividend growth stocks here, the dividend payers out of the 10 stocks, and I am going to go through those now. Okay, first off we have Apple. One of the big well-known companies. Now I've got everything set here to adjusted operating earnings as well. We can see Apple historically started paying a dividend about 10 years ago, and they have been steadily, as you can see there, increasing the dividend year on year, and that's expected by analysts to continue in coming years. Currently at a blended PE of about 27 times, and so quite richly valued. Now the analyst scorecard for earnings is pretty good over a 2-year forward. Analysts do get it wrong about 8% of the time, which means most of the time, half the time, they get it right, and about 42% of the time the company beats the analyst expectations. So what does this mean here in terms of forecasting? One of the things to remember here is the orange line here is representing a 15 times price to earnings multiple, and as we know, Apple is trading at a much higher multiple. So what that would mean is if growth begins to ease off, prices might return closer to the 15 times multiple. Now if that happened over the next 3 or 4 years, by the end of late 2025, if prices return to 15 times PE, we could be looking at a total rate of return of minus 32% or about minus 15% per year, which is quite a substantial drop potentially here. So I think at the current valuation it's quite a high risk. Now if they trade however at the normal multiple here of about 21 times PE, and by the end of the 2025 financial year they attain that level, from the current prices which are quite elevated at 27 times PE, if they return to 21 times PE, we're still talking about an annualized rate of return of about minus 1.5%. So overall here, it's a great company. It's very, very strong. I think it's also worth pointing out here that they have some pretty good estimates here from the analysts that have gone down a little bit in 2023 for the earnings, but have been fairly stable in 2024 and very good and strong, consistent strong earnings estimates for 2025. So the company certainly isn't going to go away, but the question here is this the right time to buy with prices quite elevated? Now the long-term estimated growth is at about 10% per year, so if you were going to be a long-term investor, you could probably begin to dollar cost average in. I mean, even buying at this price in 10 years, if prices return to a 15 times level, over the next 5 years, if prices return to a 15 times PE level, you're not going to necessarily lose money, but you're also not really going to have your money growing very quickly. And so buying at the right value, this is why I like to buy stocks at a lower PE ratio or price to adjusted funds from operations for REITs. Because if you're buying high, you've got more potential of this downside risk, and therefore it's something I'm very, very cautious and careful about. Now, moving on then, if we take the next stock, Bank of America, with the recent turmoil as well, I think that's affected the smaller regional banks much more so than these larger banks, but we can still see here quite a steep decline here. The blended PE is about 8.8 times. It's A- credit rated by S&P. And they've been raising their dividend beautifully and consistently since the global financial crisis and the recovery from that period. So in terms of forecasting, the analyst scorecard is nowhere near as nice as it is with Apple. A lot of the times, 2 years out or even 1 year out, the analysts are struggling to estimate what the earnings will be for this company. Now, if we look at the forecasting calculations here, a couple of quick points. It's currently trading at 8.5, 8.6 times. Normally, over the last 5 years, it's traded at about 13 times. Now, if prices were to return to those levels by the end of 2025, you could be talking about nearly doubling your money over that time period, which represents an annualized rate of return of about 29%, which is quite substantial. Now, what can go wrong? Well, it's a bank stock, so all sorts of things can go wrong. One of the positive things I think that we see here is a slight decline in estimated earnings for 2023. But and also in 2024, and a more substantial decline in estimated earnings over the 2025. So you're sort of seeing this depression or reduction in the estimated earnings over time, coupled with some relatively nice dividend yield here of about 3%. And we can see the estimated dividend increases are reasonable. Now, looking at recent changes in dividend increases, it's been sort of 20%, 40% in 2018, 2019, through to large single-digit and very, very low double-digit in the last couple of years. So you're talking about a reasonable starting dividend yield here, potentially. Coupled with some reasonably good dividend growth. Now, the long-term growth estimates, we don't have a fix on that here, but you can turn to other estimates as well, I think, like Yahoo Finance. So switching over to Yahoo Finance for Bank of America, scrolling all the way down here, this is the analysis tab. We can see that the growth estimates over the next 5 years are expected to be relatively low for the earnings, only 3.3% per annum. Now, the benefit here is if you were to buy, this is probably a nice time to buy in terms of having a relatively low price to earnings ratio at the moment, which suggests that there's some good potential upside here. So even though earnings might grow slowly over the next 5 years, it looks like we're pricing most of this estimated growth in the next several years. Because we're buying at a good valuation, I think there's some really nice potential here. Next stock here is JP Morgan. So again, I think another bank stock, so much stronger growth trajectory than Bank of America, being a very different type of bank, less sort of impact here from the global financial crisis, and since that time as well, beautiful dividend growth. So again, dividend yield of about 3%, A- S&P credit rating, so some very good results here, I think. Now this is what I like to see in an investment. So here we have over a 2-year forward estimate. Analysts get it right about 75% of the time, and the company beats their expectations 1/4 of the time. So I think that's really powerful here while looking at the operating earnings. Now, what does that mean? Well, currently it's trading at a blended PE of about 10.5 times. We can see prices have sort of run up a little bit over the last several months. And if prices were to return to the 12.3% price to earnings level that we've seen over the last 5 years, by the end of 2025, we might see a 50% total annualized, total rate of return, or a total annualized rate of return of about 17% here. Now, the other important thing to note here as well, compared to Bank of America, when we look at these analyst estimates for the earnings over the last 6 months, we see that they've been fairly stable, fairly steady, and in fact here in all cases have been revised upwards over the last 6 months. So over the last 6 months, analysts have been becoming increasingly positive about the prospects here for JP Morgan Chase. Long-term growth. Here we have an estimate of about -1% earnings growth per year, and I'm interested to see if that correlates well with the Yahoo Finance estimates. So switching over to Yahoo Finance, now the different services all have different groups of analysts reporting to them, and so I think it's also useful then having a look at some of the differences here in analyst expectations, and we often get quite different results, but here we can see actually quite a high level of congruence between the two separate groups of analysts here, with both groups of analysts expecting over the next 5 years that JP Morgan's earnings per share will actually decline. Now, as we flick back to this as well, and we begin to look at what that means, it means even though we're sort of seeing these expected earnings estimates here that are quite strong, it means that in the next several years after that, earnings estimates may actually flatten or drop quite a bit. So as a long-term shareholder, do keep that in mind. Now, the next off on the list is Microsoft. So historically, again, quite a beautiful compounder here with if we take the price off the chart, we can see a beautiful increase here in the overall earnings for the company. So the company's been very successful. We can see this over the recent years, a solid track record here of dividend growth. The dividend yield's relatively low at just under 1%, but it is AAA credit rated, so one of the top companies in the world here in terms of the credit rating. I think only Johnson & Johnson is the only other company, I believe, with the AAA credit rating here. So very, very, very difficult to achieve and very attractive here for an investor, I think. Really suggesting this rock solid value of the company here. Analyst scorecard. 50% of the time over 2 years forward, the company beats expectations. 1 year forward, they beat it nearly 58% of the time. And 2 years forward as well, they miss it about 17% of the time, and 1 year forward also they miss it about 17% of the time. So analysts do get it wrong, but the company also does surprise very much on the upside sometimes. Back to the forecasting calculator. So currently it's trading at a 30 times price to earnings estimate. I feel personally that's quite rich for me, but here you can begin to see, I think, a little bit why it trades so richly. So the estimates here are for about a 15% improvement in earnings in 2024 financial year, and a further 16% in 2025 financial year. Now I'm just going to pull the window down, and we can begin to see a little bit here the analyst estimates. They're estimating over the last 6 months. They've revised those estimates downwards for the earnings over each of these years forward, and so we'd sort of see this blue line sort of revised downwards a little bit over those years. Now what this means is at the current price it looks quite elevated, but it's usually traded at about 28 times, and you couple that with some very strong expected underlying earnings growth, and if the earnings and the prices sort of work out over the next several years, you could be looking at a total rate of return of about 28% or an annualized rate of return of 12%. So quite attractive here, but I think also from my perspective here, a lot of this is, expecting investors and hedge funds expecting continued strong growth, hence the relatively high prices to the earnings. So if we go back to the historic tab here, and I begin to put the prices back on, we can see this relatively high valuations here in prices compared to this sort of blue reference line here where it's sort of historically traded at. So we can see prices are much higher than this blue line here, representing 20 times price to earnings ratio. So that represents some downside risk. I mean, if prices were to return here to this 20 times price to earnings ratio in the next several years, for example, you're talking about here returning to a 21 times price to earnings ratio, you're actually talking about by the end of the 2025 financial year taking a small loss here, and that's including taking into account even the dividends during that time. So I think really good stock, really strong, but personally I'm not so keen on the price at this point. Now, the final stock on the list is one that has come across my desk a couple of times here, is S&P Global. So perhaps not unsurprisingly, S&P Global maybe doesn't have an S&P credit rating. It would be fairly hard to be unbiased with your own credit rating, perhaps. But a dividend yield here of about 1%. In the last several years, we've seen some fairly strong, into the double digits, generally dividend increases, which is good to see. The analyst scorecard here is exceptional 2 year forwards, with the analysts getting it right most of the time and the company beating their expectations about 1 in 6 times, which is quite a good result overall. When we look forward here at the overall expectations here, so it is trading at a very rich 30 times PE, so bearing in mind what I've just noted for Microsoft. Now, if I switch this over to the normal multiple that they've held over the last 5 years, it's been on average trading at about 28 times PE. So if prices remain at that level and the analyst estimates for their earnings are accurate, we're talking about a total rate of return of about 38% over the next several years, or an annualized rate of return of about 12%, which is nice. But we see also the analysts have been revising down their estimates for the earnings over the last 6 months for each of these years forward. So essentially what that means is this blue line would have been dropping downwards, and therefore if we'd done this calculation sort of 6 months ago, it probably would have looked like a much healthier rate of return. And that reflects, I think, the relatively high price to earnings multiple here, and those relatively volatile earnings estimates, which they're pricing in strong 11%, 15%, 14% annualized growth here for each of those years, and that's reflected, I think, here in the strong PE. As these earnings drop down, we're going to be left exposed potentially with quite a high PE stock that could potentially fall a reasonable way down. So if it returned to a sort of, again, taking a 20 times price to earnings multiple roughly as a sort of a benchmark for, I think, a reasonably good valuation for a long-term growth stock, if it returned to roughly a 19.8 or 20 times PE here, by the end of the 2025 financial year for the company, we'd be talking about a total rate of return of minus 3% almost here. And that's simply based on the fact that if growth drops off, prices could reduce, and these earnings could also be reducing substantially over the next several years as well. However, what analysts actually expect is some very strong long-term growth rates here of about 28% per year. There's only 2 analysts here providing these long-term annualized estimates, so I'd take that with a grain of salt. I'll just quickly flick over, I think, to the Yahoo Finance tab as well and just have a quick check on that. So just quickly switching over just to get a sort of a fix to see if these different analysts are providing different estimates. And here I think the estimates are a bit more reasonable, expecting about 13% annualized growth over the next 5 years. And I think it's a more reasonable estimate here than this 28%. I'd be very dubious about seeing a large company growing that much, that fast, that consistently over that period of time, and I certainly would take that with a grain of salt. But I think if we talk about a more reasonable long-term growth rate here, so switching back here, about a 13% rate of return, we can get a better sort of fix here. So again, even at 15 times or returning to a sort of a 20 times price to earnings multiple, and they can achieve 13% per year over 5 years, even at this relatively elevated price, that strong growth in earnings, if prices keep up with that, even if prices were to return to a more moderate sort of 21 times price to earnings ratio, I think you could potentially capture some very strong total returns here, although that slips down to a relatively low single-digit total annualized rate of return. So there you have it, 5 dividend growth stocks. These are held widely by hedge funds, quite the hedge fund darlings. What do you think? Which of these do you hold in your portfolio and why? Are any of these going to make it to your watch list? Let me know in the comments below, and I'll see you soon.